Thank you for viewing our webinar sponsored by Simon CIP Connect. This is the second in a series about navigating the world of special needs planning. My name is Bethany Smith-Packard, one of the study coordinators for Simon CIP Connect, and I am joined again by Mark Friese, Senior Vice President of Wealth Management Advisor and Portfolio Manager, and Chase Phillips, Financial Advisor with Merrill Lynch. During this presentation, Mark and Chase will continue the discussion about how proactive special needs planning can help protect your family while providing an empowered life for your loved one living with disabilities. Following the presentation, we invite you to submit any questions you have for Mark and Chase by emailing the Simon CIP Connect coordinator at coordinator@simoncipconnect.org. Now it is my pleasure to introduce Mark and Chase. Mark joined Merrill Lynch in 1987 and is a member of the Merrill Lynch Special Needs Council, which helps families assess and address the financial challenges of caring for a family member with special needs. He understands these challenges firsthand because his son, Christopher, has autism. Mark is passionate about sharing his knowledge and experiences with the special needs community. Chase joined Merrill Lynch in 2008. In addition to his work in helping clients to develop and implement financial strategies, Chase has a specific focus on assisting families of individuals living with special needs by helping them to develop customized financial strategies and offering investment advice and guidance with regard to special needs trusts. Thanks for joining me again, Mark and Chase, and I'll let you go ahead and get started.
Bethany, thank you so much for the opportunity for part two of our talk here, and we hope that everybody listening finds this information useful. So really the purpose of the talk today is going over our Special Needs Planning Workbook. And really I consider this the ultimate implementation guide to get you started on the right path. One of the things that we hear most often is that families are overwhelmed, the day-to-day schedule rules, and that this longer-term planning tends to take the back seat. I've also seen this personally. I was born with a disability, spina bifida, and growing up, I saw my parents really struggle with this. Between the physical therapy appointments, their neurology visits, occupational therapy, the longer-term questions simply didn't get answered on the time frame that they probably should have. So what we hope this will do is help you prioritize some of your goals and get you on the right track towards answering the bigger questions. Inertia tends to rule, so hopefully we can help all of you with that. So we're going to go through the workbook, but let me just remind everybody listening of the major concerns that we hear. And I'd say the one that's probably most paramount is the question we hear the most is, how do we make sure our son or daughter living with a disability is going to be okay both during our lifetime and after we're gone? And really that tends to be split up into three major sub-questions. That is, will there be enough money? Number two, where will they live, either during our lifetime but also after we're gone? And number three, who will be a part of their circle of support? What are the implications of guardianship? Who's going to be in their life to make sure that they live an empowered life with all of the care and supports they need to do so? And so, taking a look at the workbook, just opening up to the first page, we've really broken it up into 5 major categories. Okay? First being lifestyle. That is, who in your family is going to be involved? Who do we need to educate in terms of successor caretakers? Who will be in that circle of support? Estate planning, certainly the legal ramifications to gifting money to trusts and preserving benefits. Portfolio management, that is, do we own the right things? Do we have the right investments in place that meet our long-term goals for caring for our loved ones with disabilities? Family protection, understanding how we're going to protect assets through the transfer of wealth through generations. And, of course, liability and cash flow management. How much money are we actually going to need? How does the debt side of our balance sheet play into this? And so what this workbook is going to do is walk you through each step and really help you answer these questions and get a first point plan down on paper so that we can tackle some of these bigger questions. Okay, so let's dive into lifestyle for a moment. As you have been raising your loved one with a disability, you have probably heard of something called a letter of intent. Basically what this is a combination biography and instruction manual about your child living with a disability. What are their interests? What are their goals? What's their day-to-day routine? Who are the professionals that are in their lives that are going to need to stay in their lives when you're gone as parents? And this letter of intent is critical because it is the document that's passed along to a successor caretaker so that they have a fighting chance of filling your shoes as parents when you're no longer around. And so some of the things to be thinking about to put into this letter of intent, well, going back to the living question, where will they potentially live in the foreseeable future? What are your plans? How will that change? Probably good to have a 5-year plan and a 10-year plan. What is the date? Right? What places have you looked at to make this possible transition? Do you currently have out-of-pocket expenses for your child care? How will we fund that? Okay. So putting a letter of intent, a document in place for somebody is extraordinarily important. Now, some of the other questions you're going to want to ask yourself is, well, what would happen to your child's quality of life if you were no longer around, which, of course, is a tough question to have to ask, but it's a necessary one. You need to think about how much of your total estate do you plan to leave for your child's care. And then, of course, how does your own situation look? We all know that as parents, if we're not in the best position possible in terms of our own finances and getting through retirement, how do our loved ones have a fighting chance? So you want to take some assessment and determine where you currently stand relative to your retirement goals. So at what age would you like to retire? How much money can you retire on? This first section of the workbook helps give you at least a baseline assessment of where you currently stand relative to those goals. So I'm going to pass it over to Mark, and he's going to start talking a little bit about the estate planning and legal management of the workbook.
So legal is always a difficult part for clients because about 70% of people within the United States don't have a will. Virtually everyone postpones writing a will, mainly because we don't want to talk about it, we don't want to think about our tangible assets. In a lot of cases, we don't want to think about our own mortality. So it's very important. So there are a couple pieces that go into the will, and the will, in simple terms, is a legal document that's going to dictate how you want your assets to be distributed after you die. It's fluid. It can change over time. So we have clients come in all the time and say, I haven't done a will. I don't want to do a will right now. Well, doing it now because I think things will change. But doing it now is important because if you don't make the decisions now and you don't have a written document, then the state potentially is going to come in and decide where those assets go. And this is particularly important, of course, with this family with special needs because they have a lot of different areas they have to cover. They have to make sure their child with special needs is okay. In my case, I have 2 children. My son, Christopher, is 18, so he has totally different needs than my daughter, who now is 20. And in my legal documents, I have to make sure that both of them are taken care of, and the way they're going to be taken care of is significantly different. So that's the first piece, if you take a look at the workbook. The second part is a living trust. And I always describe the word trust as I don't trust what you're going to do with the assets, so I want to write some things down with the help of a lawyer and make sure things pass the right way. So in a special needs case, which we'll get into a little bit, it's very important that the assets pass the right way because if they don't, you may become ineligible for government benefits that you could potentially be getting. But it also is the case for a family even without special needs. And I always laugh because I think if you dig down far enough in every family structure, there is some sort of special need. It might be somebody that's a spendthrift issue, or somebody that has, substance abuse issues, or somebody has a difficult marriage, or making sure that your assets are passing on to your grandkids if something happens to your kids, all those sort of things. So the living trust allows you to be able to put language in there and control the assets held in your trust during your lifetime. It allows you to name beneficiaries where the assets are going to go. And it gives guidance and certain powers and authority to the trustee, the person who's responsible for managing the assets, and the distribution of those assets. That's how a living trust works. So what is a special needs trust? It really isn't significantly different than a regular trust, but it's set up specifically for your child or your adult with special needs. And what it allows you to do is put money into a pool, and that pool then is not owned directly by that child or by that adult with that person with special needs. So it makes them eligible for certain government benefits that are asset-based. Under the current programs right now, you're allowed to have up to $2,000 in your name. That's it, unfortunately. That's the current law. And if you have anything more than that, then your child might not be eligible for government benefits. So having a special needs trust gives you a place to put the money. It allows you to invest the money on behalf of that child, and it allows you to be able to make sure you're still eligible for government benefits. Conservatorship is another subject that people have to address when they have a child or an adult with special needs. Conservatorship means who's going to take care of the money. So who in your family structure you think would be good in helping your child. And it could be a family member. It could be an institution, so banks and brokerage firms can act as a conservator. But it'd be somebody that has knowledge in the management of money and hopefully knows enough about your child or your adult member that they'd be okay in knowing how the money should be directed for them. The fourth part on the list is a durable power of attorney. So durable power of attorney helps with parents and with kids, but it makes sure that you have health care decisions that you've listed. So it could be for health care issues or also it could be for finances. So if something happens to you, and right now 60 to 70% of families with special needs, that child is still living at home. So as Chase alluded to, we want to make sure that both parties are okay, both the parents and the person with special needs. So that means that if something happens to the parents, one person has a stroke, there's a health issue, that the other parent is able to pick up the pieces and make sure that they can carry on with their financial life. So that would mean if there's health care issues, that they'd be able to make health decisions. And in the case of power of attorney for finances, they'd be able to make financial decisions. And then the last one is a medical care directive. And some people call it a living trust, living will. And that's just how your decisions are going to be made if something happens to you medically. So these are kind of the 4 or 5 fundamental pieces that you would go into and talk to with an attorney. And I'll mention picking the attorney when you have a special needs member in your family is very important. It's not a regular attorney. The average attorney is not going to know some of these rules. There are specialists that handle that area, and so you need to find somebody that's familiar with the rules and regulations for a special needs family. So with that said, I think we've kind of covered the legal part of it. Why don't we talk a little about portfolio management? So why is it so different? So why is it different managing a portfolio for a special needs family than it is for a family without special needs? And Chase talked a little bit about it, and it really has to do with timeline. So not only are you trying to make sure that you're okay, meaning the parents are okay, but you're also trying to make sure that your child's okay. So your timeline is much, much longer. With my son Christopher, who's now 18, he's probably not going to leave the home for a long period of time. And so as the parents age out, we're seeing that happen all the time right now, we need to make sure that that child is going to be okay and the money is going to last over that long period of time. So with the investments, we take look at a lot of different things. First of all, we take a look at how much it costs. So how do you know how much it's going to cost for your child with special needs? Now, Chase is going to talk about a calculator that we have available that will help you with that figure. But it's a lot. Right now, the expenses for families with special needs are somewhere between $30,000 to $60,000 each year extra above and beyond what it is for people without special needs members. So it's a lot of money. So how are you going to handle that? Do you have enough money put aside? If you had an emergency, are you going to be okay? On the little booklet, it talks about how much do you keep in short-term investments for emergencies. The average should be somewhere between 3 to 6 months worth of expenses should be put aside. With a special needs member, you're going to have to figure out medical expenses you have for them, so your number might be slightly higher. So the last part we're going to talk about are some of the pitfalls in planning specific to special needs families. So a lot of times you might work for a company and have a concentrated position in the stock. You work for, IBM, and you have a lot of money in one particular company. So that may be okay for you handling the finances on your own, but when you have a special needs member, you need to look at things in a little more conservative fashion. So as I describe it after 28 years of experience in handling people's finances, is you want to make sure that you're taking the least amount of risk necessary, that there's nothing there that can kind of blow up and have a problem. So we try to recommend or defer to no significant positions in any one position that could hurt you. We also look at performance. How have you done? Are you trying to handle the finances on your own? Do you have a professional that's managing it for you? What are the decision-making processes? What do you do if the economy doesn't do well? Do you have a game plan if interest rates change? Right now, interest rates are at all-time lows. So some of the traditional investments that you use for a special needs trust and just for general planning, like CDs, money market accounts, bonds, things like that, are not paying very much. And when interest rates go back up again, because they eventually will, in my opinion, those particular investments will not do well. So do you have a game plan in mind to handle that particular situation? Now, we're not recommending market timing. A lot of investors, in fact, most investors, do not do as well as the general market because they do time the market. They get in and they get out based upon things that are happening emotionally or talking heads on TV. So we spend a lot of time talking about market timing is a fool's errand over the long haul. And then the last area we want to talk about is expenses. How much are you paying to have your assets managed? A lot of clients that we come into contact with own investments that have high expenses, like are in mutual funds as an example. And their expenses may be 2.5% to 3% per year that is coming out of the investments to pay for managers, to pay for trading expenses, to pay for marketing for the mutual fund companies. So we take a look at other alternatives to that, and one good example would be indexes, which instead of paying 1.5% to 2.5%, 3%, you may be paying 2 or 3/10%. So those are some of the things we want to think about. So the next section we're going to cover is family protection. So how do you make sure that your family is fully protected? In family protection, I actually did a whole seminar on this as far as finding gold. Because most families feel overwhelmed, as Chase talked about, and in the case with a lot of special needs families, they feel like they don't have enough assets to be able to fully protect themselves, yet alone their child with special needs. So the first thing I think is important is to go through and figure out what you have, do an inventory. So on the workbook it talks about, do you have insurance? Is it term insurance? Is it universal life insurance? Is it whole life? Do you have what's called a second-to-die policy, which I'll talk about in a moment? Are you confident that the amount of coverage you have is adequate? If you had a short-term disability, are you going to be okay? So you have any disability insurance through work? And what about health issues? And if you had a long-term care issue with one of the parents, would the other parent be okay? And more importantly, would you both parents be okay if something happened to them medically with a child that might still be living with them? So the first part is to do an inventory, and that takes a look at what pensions you might have, 401ks, life insurance. Do you have stocks? Do you have bonds? Do you have equity in your house? What about outside family? In a lot of cases with special needs families, people want to help. Certainly, my grandmother and grandfather wanted to help my son when they found out that he was diagnosed with autism. And so talk to them and see whether there are things they can potentially do in their estate plan that might provide assets for your child when they're no longer around. And then the last idea that I want to talk about on the protection part is one of the most commonly used methods to create a significant estate for your child for not much money, especially if you start early. And this is used in about 70% of cases for special needs families, and that's called a second-to-die policy. And the reason they call it second-to-die is because no benefits are paid out until both parties that are listed in the policy pass away. So in many cases, in planning, you'll have a husband and wife with a family member that has special needs. So the insurance policy would be on both the husband and the wife, and then when they pass away, those assets would then pass into the special needs trust. And that passes tax-free, so there are some tax savings there. And you know for sure the money's going to be available for your child. The biggest benefit, in my opinion, is emotional and financial. The financial one's easy. You take a small amount of money, pick a number, $4,000 or $5,000 a year that you put aside into a policy, and it controls $1 million worth of benefit. So that's significant leverage. It would take you a very long period of time with investing to create this sort of wealth. And the second part of that is feeling good about it, meaning that you know you're okay. So once you set that up as an example, you know that you could spend all your money down to zero for husband and wife and know there's still going to be money left over no matter what happens for that child. So it's a lot of emotional security. And the last thing I'll talk about is a new law that was recently passed that also provides some security, another place to put money. And that's called the ABLE Act, and I'm proud to say Chase is one of the people that testified in favor of this act, and it was recently passed within the last couple months. And ABLE stands for Achieving a Better Life Experience, and it's another pool of assets, another way that you can protect your family, where you can put up to $100,000 a year into the account. There's some significant tax advantages with the account. It is a subject that could take a whole other webinar, and hopefully we'll do that in this series. But I just wanted to make sure everybody knew that it was currently going to be available within the next year to year and a half, because it'll be a state-based program, and each state has to go and pass legislation to make sure that it's available in their state. So with that said, let's talk a little about liability and cash flow management with Chase.
Okay, thank you, Mark. So this is the debt side of our balance sheet, so to speak. And I think the first thing that's important to mention here is being as efficient as possible with their debt. And one of the benefits of living in a low interest rate environment right now is that we can obtain debt for relatively little in terms of interest rate. And so what you want to do is you want to make sure you're taking advantage of low interest rates. You may have an opportunity to refinance your house. There's the potential to save money on your mortgage payment each month by refinancing into a lower rate and then taking those savings and putting it into another type of saving vehicle. But what about credit card debt, the bad debt, so to speak? And people ask a lot about how to manage that, how to prioritize that, how to pay off credit card debt. And so the first thing that you want to do, and you can do it in this workbook, is just list out all the different credit cards that you have, the balances associated with those credit cards, and the interest rate associated with those cards. And what you want to do is create a game plan to pay off the largest debt first. And you work your way down. Another strategy that individuals have been taking advantage of in a low interest rate environment is you may have the opportunity to consolidate that credit card debt. Perhaps you can consolidate it into your home equity line or into your mortgage for your home. Many people may use their asset base, their investment base, as a way to consolidate debt at very low interest rates. The other thing you want to do is you want to create a family budget. You want to have a good sense of the amount of money that's coming in. You want to have a good sense of how much is going away in retirement investments. And then you want to have a good sense of how much you're spending versus how much you're saving each month. And I'll tell you a quick story of something that I do that's actually very helpful with this, is you take 1 month out of the year, you name that your month of austerity, and you think about where you can cut down on your discretionary expenses. Essentially, you're only paying for the necessary bills, only the requirements. And it gives you a good sense of what you could potentially cut out of your life that maybe you could carry on for the rest of the year. February is a great month to start this because it's the shortest month of the year. But I do this every February, and it really helps me keep my spending in check for the rest of the year. Okay. So looking back on these 5 areas for a second, we want to get a sense of next steps, right? You want to be able to manage your own expectations for getting these different things done. And what I would recommend, you jot down your notes, you summarize the work that you've done previously in the workbook into this action plan. And what I would recommend you do is you review it with a professional outside your family. It has to be a trusted individual. It could be your family attorney. It could be a nonprofit that you work with or an advocacy group. It could be a peer group, other families that you trust who are going through the same thing. We serve this role for our clients. They'll bring the workbook to us and we'll review it with them and really help to, number one, create priorities and also create a timeline for getting these different elements done. So with that, Mark's going to transition into some unique planning aspects of special needs planning.
If you take a look in the workbook, it gives you a little story. A favorite aunt dies and unexpectedly bequests $300,000 directly to your child. And that's a big problem because if the child is receiving government benefits, that instantly makes that child ineligible for those benefits. So the education of the entire family. In our practice, as an example, we spend a lot of time with what we call family-style meetings. So we're educating the family, we're educating the member that has special needs, and we're also branching out to the entire outside family, people that might be giving money to that child, people that might have insurance policies that might go to that child, organizations that might be gifting money to that person. And make sure they're all educated to know that they don't want to give it directly to that person with special needs. They want to give it to that special needs trust. And that's why it's so important to get that trust set up, because you never know when something's going to happen, and now you have this pool, this bucket that the money can go into and make sure that you preserve your government benefits. So education of family and outside family is very, very important. So in the booklet it says, have everybody receive instructions how to leave gifts. Assets are not put your child's name, so you want to interrupt the government benefits. And you also want to take a look at, a nonprofit organization or family member are the beneficiaries of assets after your child passes away. So those are all important facts to take a look at. The next area we're going to talk about is beneficiary checklist. And this is probably a problem that Chase and I see most often. And it's because a lot of us have lots of different accounts. We have accounts that we've accumulated over our entire lifetime. So you might have an old 401k that you started at a different job, or maybe 2 or 3 of them. You might have an IRA that started when the rules were different, 15 or 20 years ago. Or you might have had a couple IRAs or different banks when you were buying CDs and you were looking for the best rate. You might have insurance policies either directly through your employer or insurance policies that you purchased for yourself, life insurance. So all those assets actually have one thing in common, and that's that they're beneficiary directed, meaning whatever you put down on that piece of paper when you sign up for your 401k or your 403b or your insurance policy, you had a list of beneficiaries. And those assets are going to pass directly to that beneficiary as you listed them. So the first thing we want to do is make sure that is it correct. So if you have an old account, as an example, that you might have had a previous spouse on there or somebody that's no longer alive, or a member that you thought you want to leave money to but the situation has changed, you want to make sure all those beneficiaries are coordinated. And the second thing you might want to think about, are all those people on that list going to be okay with handling the money? Do they know how to handle money? So a good example would be my children. So my child, obviously, who's 18, Christopher, who has autism, is not going to be a good person to handle money. So he's going to have a special needs trust, he needs to have a conservator, and he's going to have somebody who's going to help him manage those assets. My daughter, who's now 20, she has her own special needs, she's a 20-year-old daughter, but she's also not able to handle money at 20 years of age. So the assets that are passing directly through to her that are beneficiary-driven might want to have some rules on those. And so some common examples would be, the person only gets money when part of the money when they turn a certain age. And then that age is you get, let's say, 20% at 30, and then another 20% at 40, and then another, 50% at 50. So you're kind of pushing the money out and making sure that they are able to handle money as they get older, and they're getting given, greater control of that. The second thing about it is in retirement accounts, as an example, there are some very distinct tax benefits. So in an IRA, as an example, or a 401k, if you are required, you've deferred that money from taxes over a long period of time. And when you turn age 70 and a half, you're going to be required by law to start taking money out of those accounts. And that distribution is going to be based upon your life expectancy. And if you're a husband and wife, you probably have an I love you designation on there, so it goes from one spouse to the other spouse. And then they're going to be required to take money out over their life expectancy. But when they're both gone, if you listed your kids as beneficiaries, your children on that account, the money for your children is going to come out over their life expectancy, which is much, much longer. And that is extremely important because that much, much longer means much, much longer you're able to defer the money and keep it away from the IRS. So instead of having a 10 or 15-year time horizon, it might be a 30-year time horizon. And the longer you can keep the money away from the IRS, the better off you are for most people. So that is called a stretch IRA. That's one word for it. And it allows you to stretch those benefits over a much longer period of time. So a lot of families want to take a close look at their IRAs and their 401ks and things like that that are all beneficiary-driven and make sure those are all followed up and looked at the right way. The next thing we're going to talk about, Chase is going to talk about, is a special needs calculator, which is a really exciting tool that families can use.
Alrighty. So probably the hardest question that families have answering is, how do we project future expenses for our loved one living with a disability? How do we possibly know what they're going to need 10, 15, 20, or 30 years down the road? And I think number one is these are expenses that you need to reevaluate every year. Number two, these are expenses you should probably be keeping track of every year. But we have an excellent tool that can help you at least project these expenses out to determine how much do we need to save, how much do we need to fund in a special needs trust, and what are the best ways to get there. So in your workbook, you have a link to our special needs calculator. It is free. You log on to the site, and what it's going to do, it's going to estimate various expenses over a long period of time. And these expenses you're going to enter. And so what you can do is in this workbook on the next page, you can actually write out the current expenses that you're spending for your child's care. You can also project any potential future income they may have. But it's pretty detailed what this goes through. So monthly housing expenses for them, projected monthly transportation expenses, personal expenses, other expenses for administration of trusts, life insurance premiums. So fill out these fields, go onto the website, put these expenses into the calculator, and what it will do is we'll show you how much money you'll need in lump sum to meet these anticipated expenses down the road. And if you're doing this in terms of probability of success, you're thinking, well, how much could I potentially withdraw from a pool of money? It's a very good chance of success that if you're withdrawing 4% from a pool of money each year, you'll have a very high probability of doing that successfully over a long period of time, as long as the money is properly invested and diversified. Okay, so the final pages of the worksheet are really for you. General information that you can put down. You can put down general thoughts in there. But again, I would highly encourage you to share this document, certainly with other family members, but also trusted professionals in your community who can help evaluate where you currently stand and help you prioritize where you're going. Bethany, we very much appreciate the time, and we are here for questions, so any participants feel free to call or email us. We're here for you.
Thank you, Mark and Chase, for such a helpful and informative webinar, and thanks to everyone who is viewing. Please feel free to submit any questions for our presenters to the coordinator email at coordinator@simonsvipconnect.org, and we look forward to hearing from you soon. Thank you.